Here's a strange fact. Banks are one of the only businesses where you can legally hold $9 of other people's money for every $1 of your own and get to keep the profit on all 10. That's the entire secret of bank economics in one sentence. Everything else, the branches, the interest rates, the regulations, the 2008 crisis, Silicon Valley Bank, collapsing in 48 hours, all of it flows from that one fact. Banks run on other people's money, and the spread between what they pay for it and what they charge for it is the business. Today, we're going to take apart how a bank actually makes money, why owning one is unlike owning almost any other company, and why the same leverage that makes banking wildly profitable is the exact thing that can destroy it overnight. Strip away the marble lobbies and the mobile app, and a bank is a spread business. It borrows money short-term and cheap and lends it out long-term and expensive. On one side of the balance sheet, deposits, checking accounts, savings accounts, CDs. The bank pays you maybe 0.5% to 2% for the privilege of holding your money. On the other side, loans, mortgages, auto loans, business credit lines, credit cards. The bank charges borrowers 4%, 7%, sometimes 20% plus. The difference between what it pays depositors and what it earns from borrowers is called the net interest margin, or NIM. For most banks, that's somewhere between 2% and 4% of assets per year. Doesn't sound like much until you see the leverage. A typical bank holds capital equal to only about 8 to 10% of its assets. The rest, 90% plus, is other people's money, deposits, and some wholesale borrowing. So a 3% margin on the full balance sheet, applied to a base that's 10 times the owner's actual equity, turns into a 20 to 30% return on equity before costs. That's the magic of banking. It's also the danger, and we'll come back to that. 1. Net interest income, the spread we just covered. For most banks, this is 60 to 75% of revenue. It's the core engine. 2. Fee income, account fees, overdraft charges, wire transfer fees, wealth management fees, credit card interchange. Banks love growing this because it doesn't require holding risk on the balance sheet. Warren Buffett has said the fee businesses inside a bank are often the best parts because they earn returns without eating up capital. 3. Trading and investment income. Banks hold portfolios of bonds and other securities, and larger banks trade for clients or their own book. This is smaller for community banks, much bigger for institutions like JP Morgan or Goldman. If you're valuing or buying a bank, the first thing you look at isn't revenue, it's the mix. A bank overly dependent on net interest income is more exposed to interest rate swings. A bank with strong fee income is more stable and usually trades at a premium. Let's go back to that 8 to 10% capital ratio. Regulators require it under rules like Basel III, specifically because banks are so levered that a small loss on the asset side wipes out equity fast. Here's the math. If a bank holds $100 in assets funded by $10 of equity and $90 of deposits, it only takes a 10% loss on those assets, a bad loan cycle, a real estate crash, to erase the entire equity base. That's not a hypothetical. It's basically the 2008 financial crisis in one sentence. This is why owning a bank is fundamentally different from owning a normal operating company. You need a regulatory charter, state or federal, and continuous supervision from agencies like the OCC, FDIC, or Federal Reserve. You face capital requirements that limit how much you can lend relative to your equity. You face liquidity requirements. You have to hold enough cash and easily sold securities to meet withdrawals. Your growth is capped by how fast you can raise or retain capital, not just by how many customers want loans. Regulation isn't a side note in bank economics. It's a structural constraint on the entire business model. It's the price of being allowed to run at 10 to 1 leverage with government-insured deposits. Because banks fund long-term assets, loans, mortgages, with short-term liabilities, deposits people can withdraw anytime. There's a built-in mismatch called duration mismatch. Depositors can pull their money out today. Loans take years to pay back, as long as everyone doesn't ask for their money at once. This works beautifully. It's literally called fractional reserve banking, and it's how banks turn short-term deposits into long-term credit for the economy. But if depositors panic and all try to withdraw simultaneously, the bank has to sell assets fast, often at a loss, to raise cash. That's a bank run. It's what killed Silicon Valley Bank in 2023. Rising interest rates crushed the value of their bond holdings. Depositors got nervous, and $42 billion left in a single day. This is why deposit insurance, FDIC in the US, insuring up to $250,000 per depositor, exists. It's not charity. It's a stability mechanism that prevents rational panic from becoming a self-fulfilling prophecy. There are two paths. Buy an existing bank. Community banks trade based on a multiple of tangible book value, usually 1x to 2x book value for a healthy bank. Sometimes below 1x if the market doubts the loan book's quality. A small community bank with $200 million in assets might have $20 million in equity and trade for $20 to $40 million depending on profitability and growth. You're also buying the charter itself, which is valuable. New charters are rare and heavily scrutinized. Start one from scratch, a de novo bank. This route requires regulatory approval, which can take 1 to 2 years and is far from guaranteed. A minimum capital raise, commonly $20 to $30 million or more, depending on the state and business plan.
A demonstrated management team with banking experience, regulators trust, to profitability. Since new banks lose money initially while building a loan book and deposit base, you're not buying a widget factory. You're buying a regulated, highly levered financial intermediary, and the price reflects the quality of its loan book, its deposit franchise, how cheap and sticky its deposits and its regulatory standing. If you own one, here's what you'd be optimizing. Cost of deposits. Banks with a large base of low interest checking accounts versus expensive CDs have a structural cost advantage. This is often the single biggest driver of long-term profitability. Credit quality. Every loan is a bet the borrower repays. Bad underwriting shows up 2, 3, 5 years later. Efficiency as loan ratio, operating expenses as a share of revenue. Well-run banks keep this near 50 to 55%. Struggling ones creep towards 70% plus. Interest rate positioning. How exposed a bank is to rates moving, which is exactly what broke SVB. The best-run banks aren't the ones taking the biggest risks for the highest yields. They're the ones with cheap, stable deposits and disciplined lending, and extremely profitable over time. Owning a bank is really owning a leverage machine wrapped in a regulatory cage. The leverage is what makes a thin interest margin turn into a strong return on equity. Capital rules. Deposit supervision exists because that same leverage can unwind violently and take depositors' money with it. That tension, maximize the spread, respect the leverage, survive the cage, is the entire economics of banking in one line. Every bank that's thrived for decades, every bank that's collapsed forgot it. If you want more breakdowns like this, subscribe, because the next video might completely change how you see money.